In this video, guys, we're going to talk about simple ways to structure a trade, specifically from the stop loss position perspective. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. And if you like this kind of video, a like is much appreciated. How rude of me asking you for the like before you've watched the video. If after this video you've liked it, you think you're going to take something away from it, you appreciate the content, then a like is much appreciated. Of course, I'll ask you for the like then. If you don't like it, absolutely fine as well. I think I've get rid of the dislike button. I don't know why. It helps give feedback and go, well, actually, if people don't like the video, then I'm going to do more about it. But hey, that's YouTube for you. Anyway, guys, if you dislike it, then absolutely mention in the comments, of course. If you don't find any value from the video, that's fine. And if that's a majority decision, if you like, this is almost a democracy in a way, and I'm still going to produce content I like to talk about because I'm passionate about the markets. But also, if you guys say, nah, there's going to be value from that, no value from that, then I'll take it on board and I can adjust the content to stuff that gives you value. Because the point of you watching these videos is, not everything's going to hit the mark, but if you take one or two little bits and take it in your trading and go, it helps you get over a hurdle, gets to the next level, gets you to profitability, gets you to this, gets you to that, then that's a job well done from my perspective. And I like doing these videos as well, guys, so I'm going to do topics that you enjoy and topics I enjoy, and if we can find that middle ground, the perfect solution, right? Okay, so let's go on with the actual topic. Simple ways to structure a trade. It's very hard sometimes to come up with a sensible stop. Now, sometimes it's very obvious. If you're taking a trade that's a fake out, pushing back, for example, then the stop is very likely to be under that key level. But sometimes you take a trade and you kind of, where do I take it? Where do I structure it? Where do I put the stop? And sometimes you want to get into a trade that may not be a very defined trigger, but you still want to get in because the broader picture's good. And then where do you put your stop? And actually, very many people are doing okay and their executions are spot on, but it's their exits letting them down. So step outside a little bit and just think, maybe I don't have to always be putting my stop under a key level, which I put here. Maybe I can think a little bit differently about it. Maybe I can have a hybrid model where I start out with a fixed wide stop based on, let's say, an average true range ATR, and I say, okay, that's my kind of stop, it's a 100-point stop, and as the trade starts to go and I start to see the response, then I can adjust the stop. Because this is important, guys. When we take the trade, the snapshot we see in front of us is very different to what happens after we've in the trade, okay? So we see the trade, we see the snapshot of the market, we see, let's say, market's rallying, comes back, and we've imagine we found a little bit of support here. That's our snapshot at that moment in time. How we look at the trade after 5 minutes, 15 minutes, few days, or whatever time frame we're trading, now we've got something different. The market's dynamic. The market can change that appearance massively. And so it's important to take into consideration and say, right, well, the stop initially is going to be 100 points, and it's going to be like a fixed ticks pips of 100 points because maybe the range of the day is 300 and I want to use 30%. So you do like a 33 or a third, should I say, ATR, and you say, right, my stop is 100 points there. And then you start off like that. And then as you start to see more, you see strength or you see weakness, you see this, you either leave it or you can adjust it. So if you're struggling to come up with a stop position right away, just default to something like, if you're day trading, third of the daily range, or if you're swing trading, whatever makes sense to you. You go and have a look at the average true range and say, right, what do I want to use for that? Or go on the wider side rather than narrower side is my advice with that, because the wider you are, the more room it's got, and the more you can always tighten it and go, you know what, this is kind of generally what you'll discover. Is my wide stop. The times I'm stopped is going against me straight away, or there's very rarely times it's going 80 points and coming back. It's going 100 points and stopping me straight out. So actual fact, I could probably do 80, and maybe I can do 75, maybe I can do 60, maybe I can do 50. So it's that scenario where you're thinking, hey, I just need to start wide and then try to take it smaller. So ATR is a good thing. Percentage of today's range is another good thing. Now, obviously, if you're trading straight at the open, that's going to be small. But at least rather than ATR, which is obviously an average over X days, we've got 10-period ATR, 10-day ranges, today's range might be better, because sometimes wide range, sometimes narrow range, and you're like, well, I've got 100 point stop, but today we're only doing seems to be in 100-point range because we're quite a narrow range, and I think we're going to bounce off this level. It's a kind of narrow range day, it's a range type rotation mean reversion type day. Why do I use a massive stop? Once the market is matured enough to make a decision on the daily range, let's say you've had the open, and most of the time, guys, as well as you know, that highs and lows are put in at the opening 30 minutes in the day most of the time. So you can use that and say, right, there's my open, there's my range, I'm going to use 50% of that as my stop. And that's a little bit more focused on the current volatility rather than ATR, just a little bit more. They've got fixed ticks, pips. That's probably similar, but it's easier in your mind sometimes to go, yeah, I always use a 100-point stop, always use a 50-point stop, always use a $4 stop, whatever. It's easier to do that. Now, if you're trading different instruments, of course, different stocks, then that's not the way to go, because you're going to have different prices for the stocks that you're trading, and you probably want to use an ATR and do a quick calculation and work out what that is actually in dollars, rather than use the fixed ticks pips. That works well if you're like specifically trading crude, or you're specifically trading NASDAQ, or one index future or something, and you know that that's the metric, that unit of tick movement is the same, whatever happens. Under a key level, so this is okay, but I think this is where we struggle as traders. We sometimes struggle and say, hey, this is the key level, or this is the key level, should I say, and I'm going to put it under there. And very often the market comes and probes and tests. And so one thing I prefer to do is take that an extra step further and say, right, what about key level plus or minus, depending if we're going long or short, a percentage of ATR? So now we go, okay, here we go. We're normalizing for volatility with the ATR, the average true range, and we're concentrating on price structure and price action by looking at the key level. We're combining those together, adjusting for volatility, looking at the current price action and saying, right, that's a reasonable level. I now want to put my stop there, plus, or in this case minus if we're going long, 10% of the ATR, for example. So you might go, right, the ATR is 300 points. I'm going to use a 30 points under that level stop rather than just under it. So you're using a hybrid, and maybe it's 50%, whatever you choose to do, but you're using a hybrid. So basically saying, okay, that allows me for a fake out, because really a fake out is unlikely to go 30% of the daily move. If it's a fake out, it's probably going to just kiss under and come back. If it starts to go further and further, then I probably don't want it. Another thing you can do, which I didn't write on here, which is it can be very, very effective, is to use a time under a key level. Okay, so use your key level. Now this is a little bit more open-ended and perhaps a bit more advanced, and you kind of can't, but you can combine it with two. So you can say, right, I've got a max stop loss here, there's my key level. Time under key level means, hey, if we close more than, say, 3 candles, 3 5-minute candles, if you're trading intraday, under a key level, then I'm out. And the worst case scenario is this. Now you start to add some complexity, which you might not want, but it also allows the market to fake out, sit there, and then come back. But if it sits there too long, like 5 minute, 5 minute, 5 minute, you're like, okay, it's accepted that as a new level. I don't want it anymore. The idea was it was a kiss and run type trade. It was a movement to highs. It was a momentum ignition trade. I don't want it anymore. So you can start to play around with that. The thing is that, I think we've got to be a little bit more clever with our stops, guys. I think that the current conditions and the market environment and with the algos and all this type of stuff, we have to adapt, we have to adjust. And putting our stops under key levels and doing this is fine under certain types of trades, absolutely, because it's a very specific trade. But other trades, the key levels are tested. They go under a few times, they make a wick, they kind of go back into the wick, they come out. There's all these, the market subtleties and nuances has changed, and so we must adapt. And so we need to go, right, I need to normalize for volatility, because this expansion and contraction of volatility is a killer if we're not in tune with it. I need to still use price structure, but maybe I can combine the two. Maybe it is a key level with an ATR. Maybe I start off with a fixed ticks, and then as we start to get 15, 20 minutes, 30 minutes in the trade, if you're day trading, I then review and adjust it under any level that's now been created, and add a little bit of cushion with an ATR. So explore. Think, explore. It is not necessarily the whole structure of a level here, and it's never going to breach that level, and that's my key stop. That's fine, again, under certain things, repeating myself a little bit, but sometimes we need to be a little bit smarter. We need to think a little bit like a game of chess and think, okay, market could still kiss through that, take out some stops, and then ping higher. I don't want to be involved in that, but I still want to manage the risk and not have it open-ended. Maybe I can utilize that by having a volatility component and a price action component to the stop loss and structuring the trade. Phew, hope I didn't talk too fast for you guys. Take care, see you next one. Bye-bye.